Over the decades, few subjects in the financial markets receive as much press as the cost of money and the price of precious metals such as gold. At the forefront of financial journalism, interest rates, stock prices, and gold prices have become the investor's trifecta. Much has been written on how interest rates negatively correlate with gold prices. As the story goes, when rates decline, gold rallies. When rates increase, gold prices decline. Economists attribute this price behavior to the fact that gold generates no income investors, while, say, the 10-year Treasury note does produce income in the form of 2 coupon payments a year. In general, this theory might be true. However, there have been times when gold has rallied in the face of rising interest rates. In the mid to late 1970s, interest rates started their long historic march upward from single digits to mid-teens. 3-month Treasury bill yields rose several-fold from under 5% to over 15%. Turning conventional wisdom on its head, during this same time, gold had its historic parabolic uprise, taking its price from under $200 an ounce to nearly $900 an ounce. In addition, for most of the decade of the 1990s, gold declined against a backdrop of lower rates. Why the disconnect? A number of factors besides interest rates influence gold prices. Global supply and demand are key impacts. And given the long lead time to convert a major gold find into a working gold mine, supply seems to be relatively steady in terms of production. And supply disruptions are rare, given the extensive global gold producing network, but demand shifts dramatically with the whim of investors, central banks, and traders. Sometimes the short-term shift in demand completely overrides the interest rate argument. For example, a large central bank purchase of the yellow metal would likely drive the price of gold higher even if rates were rising. As we said earlier, market participants point out the negative correlation between rates and gold. But some actually dig deeper and compare gold price action with real interest rates. In other words, rates that take into account the inflation rate. Going back to the late 1970s, rates skyrocketed, but real rates did not, and that was because inflation spiked as well. Hence, gold investors paid less attention to actual rates and more attention to what was causing the spike in rates, namely inflation. If you were to compare real interest rates over time with gold prices, you see a better picture that backs up the theory that gold moves inversely with interest rates. Real interest rates have slowly declined since the early part of the century, and gold has generally advanced. The long-term trend is pretty distinct, despite some short-term counter-trend moves, where gold moves higher with higher rates and lower with lower rates. Over the past 40 years, there have been major moves up and down in both precious metals like gold and in interest rates. CME Group offers a vast product suite to take advantage of movements in gold and interest rates. I hope you learned a little bit more about these two products and now have a better understanding of the various forces driving this inverse relationship. Thank you for watching, and don't forget to do your homework.